One of the things that has been happening these last few weeks, and I'm taping today on December 7th, just to sort of put this in perspective, we found that the House of Representatives has passed a tax law. Now, I've been living in the land of ifs. When my clients ask me questions about tax law, they go, so what's going to happen? I said, well, if Congress acts, then this is what might happen. And that was like a huge if earlier on in the year. And it wasn't until the end of November that the House actually passed part of the bill. It was then going to go to the Senate. And the Senate was really close on a lot of things. And if you've been following anything in the news, you realize that the Senate oftentimes shoots down bills that come from the House of Representatives. But when it went to the Senate, my ifs got a little bit smaller because the Senate passed it by one vote. So it's like, okay, this thing might actually take place. However, the differences between the House bill and the Senate bill were different in some cases. When that occurs, it has to go to what's called reconciliation. And that's not unusual for tax bills to go that way because one House says we should do it this way, the other says we should do it that way. So those differences have to be reconciled. So the next thing that had to be done is that there had to be a vote sending it to committee, and that passed as well. And that happened on like December 4th. And so, and I don't even know if you're one of those type of people like me. I stayed up till 1:30 watching the votes to make sure it actually made it to that point. So right now, that's where the bill is today, December 7th. And it's going through a lot of discussions in terms of what's going to be in the final bill and what's not going to be in the final bill. What's going to happen next will be, it'll come out of that conference, and then it's going to go to the House of Representatives. They will vote on it. Most likely they will vote on those changes. And then it has one last hurdle, and that's the Senate. And if the Senate passes it, and all you need is one or two defectors in that, and it may not pass, at that point in time, it goes to the president's desk and it's done. Okay, and then we have tax law. That's a long ways to go still, even though they're expecting it to be on the president's desk by December 18th, which is why we decided to shoot this today to let you know about some of these changes, because as a CPA, forgetting about me lecturing or stuff like that, I've been in contact with my clients telling them that this is where we currently stand. This is how the law may impact you. Now, obviously, I'm not telling everybody, but I have some key clients that are kind of interested in this, and they have between now and December 31st to make some action. So my goal was to inform them of what's going on, just so that they're ready, not necessarily to do anything today, but to be ready. So what I thought I would do is I would share some of those things with you, just to let you know that these things are coming, and let's stay on top of them as we get to the end of the year. And let's be a value added to our clients and maybe notify them of some of the things that specifically pertain to them. So what I do is I sort of look at some year-end steps that I want to take a look at. And in general advice, if somebody said to say, just in like one sentence, what are you telling people to do? It probably has to be defer the income until next year if possible, and accelerate any deductions into this year. That's going to be a kind of a theme for some of the things that I'm going to say, but believe me, this law is like so stinking big that I can't address these in the time that I want to do it. So I've got a few things I want to share with you. And so I'll start over here. Is that the top issues that I've been looking at are, number one, the new standard deduction. Number two, the loss of many Schedule A deductions. Number three, the pass-through taxation. These are especially good for small businesses. The sale of a principal resident, which was something that, I don't want to say it crept out of the bill, but it caught me by surprise until I started reading the text of it. And then what's really important is why they need us more than ever, that being our clients. Some of the jokes I've had from some of my clients have been things like wow, you're going to be out of business after this new Simplification Act takes place. And it's like, folks, I'm going to be busier than ever. So I don't necessarily agree with that conception. But at the same time, I'm hearing it, and I'll address that at the end. But let's first talk about the new standard deduction. I'm calling it just for now the new super deduction. I think you realize that when you look at the standard deduction that we used to have, it was smaller. And you're hearing that the new enhanced standard deduction is going to be $12,000 if you're single, $18,000 if you're head of household, and $24,000 if you're married filing jointly. And, I said to myself the first time I heard it, wow, I know what my current standard deduction, I don't take a standard deduction, but the current standard deduction is like $12,700. It's going to go to $24,000. I was like, oh, that is so sweet. That's going to eliminate a lot of people even itemizing their deductions when they go to file their taxes. It's going to be really good. And I said, wow, that's going to be this plus my exemptions plus this is really a really good day. Until I found out that it comes with a cost. Folks, there are no more personal exemptions or dependency exemptions allowed as a deduction. So what happens is that that big standard deduction that you have now includes the deduction for dependencies and personal exemptions, if you didn't catch that in the bill. It's one of the things that they sort of kept quiet for a long time, and now it's out there for people. So what we end up having, if just to sort of put this in perspective, a single taxpayer who gets a standard deduction of $6,350 plus gets a single personal exemption of $4,050, their total amount that they would get as deductions under the current law for 2017 would be $10,400. For married filing jointly, it's $12,700 plus 2 personal exemptions of $8,100 would give a $20,800 total deduction that they would get. If you can merge these two slides together, it would look like this. Under the existing rules, the old total would have been $10,400 and the new standard deduction is $12,000. It's not a big difference, but it is still a difference. And what it does is that it allows taxpayers, in looking at a lot of itemized deductions that they might have had, they're not going to get them anymore, but maybe now the new standard deduction makes more sense for them. Married filing jointly is $20,800. That's compared with the new standard deduction of $24,000. So that's a significant increase, but not when you realize the fact that there's $8,000 of exemptions that you're not going to get. But what happens if you have children? That's the part that people start, when they start putting this all together, it's like, I got 6 kids. No, I don't have 6 kids, okay? But people ask those questions. What ends up happening is that if you have simply one child, and that's what I have on the very first line there, that the total amount of exemptions, dependency and personal, would bring your old total up to $24,850, and your new standard deduction is only $24,000. It's like, I'm going to lose out on this thing. Hang on for a minute. Married with 2, it goes up to a total old of $28,900. That's compared to $24,000, it gets even worse. But what Congress did is they added something in there that we hadn't seen before, and that is an enhanced child tax credit. Now, we've seen a child tax credit before. It was $1,000, okay, and it was $1,000 per child under the age of 17. So it's been enhanced. I'm not going to go through all the details because it could obviously change, but the House version said the new tax credit for children is going to be $1,600. The Senate version said $2,000. That's a difference. Those things have to be reconciled, so that's what they're going to do in committee. There's also more generous phase-outs, so that it used to get phased out at a relatively low level, but still pretty high income, and now it's going to be significantly higher, but the credit's going to be a non-refundable credit. And if you remember, we used to have the additional child tax credit refund. That thing is basically disappearing, and it simply can wipe out your tax, but it's not going to give you a refund. So when you start seeing provisions like that, you realize that the tax laws are changing, but you have to take into consideration other factors, not just a single factor. I know that when I get questions, it's always focused on the first part, but never on the second part, saying that you're probably going to be better off with this, the way it works right now, than you were before. And it's really on a fact-by-fact or case-by-case basis for my clients as I work through it. So I've just addressed the standard deduction, but also when it comes to some of the new law changes, what about itemized deductions? Does this even make any sense anymore? And so one of the things that I want to let you know about itemized deductions is this is what we currently believe is going to be in the law. I'm saying this for a specific reason for planning right now, not to give you a litany of different changes. You can go to a website and find them all if you want to. But medical expenses remain as a deduction, but they dropped it back to 7.5% again. Somebody lobbied for the elderly to get that type of constituents in there. So medical expenses still stays on the book. That was slated to go away, but it's back in. So we're going to be stuck looking at co-pays for another couple of years. Real estate taxes are deemed to be capped at $10,000. Those were also supposed to be taken out of the bill completely. They made their way back in as part of the concession process. So that's going to be capped at $10,000. And again, this still has that little if to pass. It has to pass the House and Senate one more time before the president can sign it. But we're looking at this. Mortgage interest deduction is only going to be allowed on one home. And I've seen 2 versions of it. I think one version had $500,000, the other one had $1 million. From what I'm hearing is that they believe me it's still going to be capped at $1 million of maximum indebtedness as you go through it. And they have not touched, at least to my knowledge, anything as it pertains to the charitable contributions. So realistically, for most of my clients, we don't have medical. Some of them do, but most of them don't. They've got real estate taxes, they get mortgage interest, and they get charitable contributions. That's where we'll be spending our time. But here's what's going to go away. State income taxes and other taxes will not be a deduction anymore. If you have interest on a second residence, that's no longer deductible. If you have a home equity loan interest, that's not deductible either. So we're losing all of that. You just get one residence, and right now, $1 million looks like the threshold. Casualty losses have disappeared. If I do one casualty loss every 2 years, it's a loss. It's a lot. So that's probably a non-starter for a lot of people. And you know those miscellaneous deductions down at the bottom where you have to spend, how much did you pay in dues, how much you do for professional subscription, what about your work shoes, which is probably a lie anyhow. All of those type of things, our tax preparation fees, your employee business expenses, gone. So those pieces sort of like walk out of the analysis completely. And so your itemized deductions are going to be significantly smaller. So what I did is I did a profile for another of my clients, and it looks something like this. For 2017, if I have a married taxpayer filing a joint return and they pay real estate taxes of $7,000, they can deduct it not only in this year but next year. Okay, that's easy. It's under the $10,000. If they paid state income taxes, which they do because we're in Massachusetts, which charges a ton of taxes, the $5,000 I could deduct this year, I can't deduct next year. My mortgage interest, assuming it's under $1 million, which with those numbers you realize it is $15,000 fully deductible. The home equity loan that I have is $3,000. I can't deduct that next year. Charitable contributions I gave for last year, I can still deduct for next year, assuming all things stay the same. And my miscellaneous deductions of 2 that I got, I can't take any of those. So bottom line is for 2017, my itemized deductions would be $36,000. For 2018, they're going to be $26,000. Since my standard deduction next year will be $24,000, I can easily say I have more itemized deductions than standard, so I'll itemize deductions. But just from the tax law change along, my itemized deductions just dropped by $12,000 in this scenario. This is not an unusual scenario. This is like what I consider to be an average taxpayer. And I kind of use this as I walk through with a couple clients. This is where we are. I just get it from the tax returns. This isn't magic. It takes time, but they let me know, I let them know that I'm thinking about them in terms of things that they can do. So what do you mean, what are things that we can do? Well, let me use what I did for one of the people that goes to our church. So this is really our church's name. I said to him, I don't give to Grace Church to get a tax deduction, but I get a tax deduction when I give to Grace Church. That's kind of the way I kind of look at tax deductions in there. I don't give simply to get it, all right? And then I say, or at least I did get a tax deduction. And that's where things are going to start changing. If I change my model just a little bit, so I drop my real estate taxes a bit, and I drop my mortgage interest a bit, and keep everything else the same, you'll notice that in 2018 now, my grand total is $22,000. And so as a result, by giving $22,000 in all those deductions next year, I'd be better off just taking the standard deduction. So I'm really not getting any direct benefit from making a charitable contribution. So if I wanted to maximize where I'm going to be at the end of 2017, what could I do? It's simple. Take the things that I can't deduct next year and see if I can accelerate the payment into this next year. So if I'm getting close to December 31st and I know I'm going to owe the state of Massachusetts $1,000, I'm going to make sure I pay that $1,000 before December 31st because I can deduct it this year. If I pay the state income taxes next year, which I'm going to have to, I can't deduct it. So by moving $1,000 into this category for next year, I can accelerate the deduction, and if I'm in the 25% tax bracket, I've just saved $250 that I wouldn't save next year because I can't itemize it. So I'm basically trying to make good on things that I'm going to lose. I don't think I could do much on a home equity loan. And miscellaneous deductions, sure, there are a few things in there that if I'm over the threshold, I could probably accelerate into the new year. But what I've been telling some of the people from the church that I go to is that if you take the charitable contribution line and a gift that you probably would have made next year because you're going to make it anyhow, you just accelerate it, make it a year-end gift for move. It used to be $4,000 and $4,000. What if I moved it so it's $5,000 and $3,000? Well, that's going to add that extra $1,000 this year. You can deduct it this year because next year it's not going to give you any benefit unless you give a lot more. And of course, I always say give a lot more and you'll get more of a deduction. But the reality is that there are things that we can do before the end of the year to enhance some of the deductions that we basically have. And most of them are moving things around. And that's where I said what we want to do is accelerate the deductions if we possibly can because of the benefit that we'll get because we're going to lose them next year. I want to talk a little bit about the pass-through tax. It doesn't sound like an exciting area, but it's an area that I'm spending a lot of time in because I have a lot of small businesses that are LLCs. They could be an S corporation or maybe even a partnership, acting an LLC partnership. And what happens is that the income from those transactions that they have, the profit, if you will, it flows through the entity and then they get taxed personally on it. What we're seeing is that next year, the corporate tax rates under this proposal will go from 35% down to 20%. So all of a sudden, being a regular corporation is going to give you a lower tax bracket than before, and a significantly lower tax bracket. And as a result, the idea of saying, I'm going to form an S corporation or I'm going to be a partnership so I don't have to pay taxes at the corporate level, all of a sudden corporate levels are way down. It's like, wait a minute, I want to pay taxes at the corporate level, because they're lower than my level. I'm still at like 38% or maybe 25% even. So that the idea of paying a tax personally now is more onerous than if it was in a corporation. So what Congress is working on is coming up with a deduction. And that deduction is going to reduce your profit in your S corporation, in your partnership, whatever. So instead of if you make like $100,000, instead of being taxed on $100,000, you're going to be taxed on maybe something like $75,000, some percentage of that. And that amount, when you tax it on a smaller piece, lowers your effective tax rate. They want to get it down into the low 20s, and they're playing around with different things right now. They're trying to say, is this going to be for service businesses, not service businesses, but it's for manufacturing and selling. So this is something we're watching. Now, how does this impact us now? Is that if you're looking towards end of the year stuff in this case, do you want it taxed currently at the highest tax rates for individuals, or do you want this income to be taxed next year at possibly a lower rate? So I'd be in a situation with your clients to legally defer the recognition of income if they don't have to recognize it this year. I'm not saying to fraudulently do anything, folks. I'm just saying that the timing of invoices and the recognition of income process, don't worry about necessarily pulling it in at the last minute to be taxed at a higher rate than if you picked it up for next year. So consider the deferral of income, especially if you have some of these small businesses. And at the same time, rental income is going to be considered as pass-through. So when you go to do the computations of it, if you're a high-income taxpayer that's paying 25%, 33, 35%, all of those higher brackets, your rental income next year is going to be taxed at a lower bracket. And that's going to be significant, again, if this basic law passes. Sale of principal residence. This is one that kind of caught me. When I was going through and I looked at it, it wasn't much. It was just like a single line and the changes. And I think most of us know this, that if you sell your principal residence and you're married and file a joint return, you can exclude up to $500,000 of the gain. And if you're single, it's $250,000. Okay? And the rule is you must live in it 2 out of the last 5 years. I got a guy right now that's in that situation. He's trying to sell his home. He's in basically the 5th year. It's straddled between years. But he's in essence, that 5th year, and he's trying to sell it. And he was going to sell it before the end of next year and still meet the 2 out of the 5 year criteria. Well, one of the provisions is that it's not 2 out of 5 years anymore, but it's 5 out of the last 8 years. That's significant because he's been out of the house now for 2 years, 2.5 years, and he's just trying to sell it at this point. He's not going to move back into it to meet the 5 out of the 8 year provision. This is something that the clock is ticking up through December 31st on it. He's got a big gain on this thing. This $250,000 gain at the capital gains rate at 20% for him, it's going to be a $50,000 increase in tax if he doesn't sell it by the end of the year. So he's working on these things. If you've got people exposed like that, that's like really, really good to know if you have that. So, I mean, I'm doing things like what can we do before the end of the year on these things? Now, am I saying to write a check today? No. What we're doing is that we're watching what's going on. We're not necessarily acting today on it, but we're trying to get things done and ready in case this thing happens at the end of the year. Other things that are changing, real quick, real estate tax lives being dropped down to 25 years. So it used to be 27 and a half years for rental and 39 for commercial. That's going to be a shortened one. So if I was in the ability to buy something, maybe I want to postpone it for till January to the new year. We can have larger write-offs on tangible personal property. Personally, none of my clients even cap out at that $500,000 for Section 179, but that's going to be enhanced as well. That'll be good for bigger businesses. I mentioned the corporate tax rate dropping down. Educators' deduction is going to move up to $500 per person instead of $250. So if you've got somebody that's an educator and they always come up with at least $250, just make sure that next year they know it's going to be $500. So once you hit the $250, stop. Don't do any end of the year buying. Save it for next year when it goes up to $500 if that's a possible threshold. The Affordable Care Act individual mandate is going to go away as well, which means you're not going to have insurance. This could open up all kinds of great opportunities for your small business clients that might want to pick maybe a high deductible plan and reimburse their employees rather than having something that qualifies under ACA. There's all kinds of options that we have when it comes to these things as well. And the estate tax exemption doubles from the current $5,490,000 that you're going to die with an estate of that much. So now it's up to $10,980,000. I guess my only advice is tell your clients not to die before the end of the year if they have a lot of wealth. And if you have some questions, call me on something like this. But those would be nice clients to have in that regard. So I started off by saying, people are joking me, it's like you're going to be out of business. But the reality is when you start going through this tax law, currently there are 479 pages of new tax law. That's a lot of pages. And they're marking it up and they're going through it, and we've got to go through and disseminate it. And yes, software will help. But we're going to get new regulations to interpret what some of these things mean. And they need us as the professionals to come in and to assist them during that time period, and especially these next couple of years. You will be spending time during tax season talking to them about these rules. Forget about that postcard simplicity. Hey, people can file their own taxes now. It'll be so easy. Maybe they can, but you know what? These are the same clients when you give them that Form 8879 to sign, is that to allow you to file their tax returns electronically. They sign in your spot. They ask, if they hit their spouse instead of them. They don't even know how to sign a stinking acknowledgement form. They're never going to be able to pay their taxes. But bottom line, you have to make those decisions as you go along. So what I would say is during this tax season, evaluate your clients that you have. You probably have clients you don't need and probably don't even want to deal with. And if you get clients that are saying, so next year, how much are you going to charge me? You probably don't want that person for next year. You're the trusted advisor, not just for putting numbers on a form, but also providing them tax advice and information that they need as it pertains to their individual issues as well as some of their professional issues as well. Identify the clients that you want to have and get more clients like that, because this is a great opportunity to walk through your practice and get rid of the stuff that you don't want to deal with. One of the first things I thought about are the clients that I don't want to deal with anymore, and they go, I can do mine next year. I go, I think you can. And let them go, because I don't make enough money to spend my time answering their questions all year long. Work on it and expanding your practice. If you're currently thinking about becoming an EA and you're not one right now, that's a great opportunity to increase it so that your professional credentials will increase and you become a more value added to it. If you're an EA and thinking of becoming a CPA, same, great time to start looking at this, because you can become an expert in the new tax law and you can be the people that help explain it to your clients. So with that, I want to thank you for listening. Give me a chance to talk about something other than the sale and disposition of property, and I hope to see you in some of the other videos we do. Take care.